Welcome to DebtCircle Key Roundups. I am Vijendra.
And I'm Leela. First up, the NSE has introduced electronic gold receipts, a move aimed at boosting transparency in the gold market. Then we have GMR Power making headlines by pledging 89.1 crore shares to back their upcoming NCD issue, signaling strong backing for their financing plans. We'll also talk about the growing prominence of REITs and INVITs, with assets under management expected to reach 20 trillion rupees by 2030. It's an exciting time for structured finance and investment trusts. Let's dive into these topics in detail.
The National Stock Exchange of India has launched electronic gold receipts or EGRs, which are dematerialized securities fully backed by physical gold stored in SEBI accredited vaults. This ensures secure, transparent gold ownership and trading directly on the exchange. The NSE aims to create a transparent ecosystem for gold trading that enhances price discovery and broadens participation from jewelers, refiners, traders, and institutional investors. And ultimately, this development should build trust and strengthen India's gold market infrastructure by providing a regulated and efficient platform for all stakeholders.
This move formalizes gold trading by integrating it with financial markets, allowing investors to hold gold electronically with guaranteed quality. It also enables trading in smaller quantities, which should improve liquidity and align gold with other demat financial instruments. By enhancing transparency and efficiency, EGRs aim to improve price discovery and broaden participation among jewelers, refiners, traders, and institutional investors, strengthening India's gold market infrastructure. And overall, this development should build greater trust in the gold market, supporting a more formalized and robust ecosystem for gold trading across India.
Now, GMR Power and GMR Estate Management pledged 89.12 crore shares to Vistra ATCL on June 11, 2026, securing non-convertible debentures worth Rs 1,400 crores. This covers nearly 72.13% of promoter holdings. The NCDs are unrated and unlisted, with a coverage ratio of 0.79, and the market value of pledged shares stood at Rs 1,100 crores. Notably, GMR Power pledged 100% of its shares while the promoter pledged 13.34%, and combined, this pledge exceeds total share capital due to overlapping holdings.
This move funds promoters' personal use, not company operations, impacting market perception. The pledged shares market value was 1,100 crores, creating a coverage ratio of 0.79, showing the collateral is less than the debt amount. Given the shares are listed on major exchanges, this large encumbrance may affect market perception and liquidity, and such high encumbrance signals promoter reliance on pledged shares for financing, so investors should watch for risks linked to promoter leverage and potential share volatility.
India's real estate and infrastructure investment trusts are projected to double assets under management to over Rs 20 trillion by 2030, driven by expected inflows of Rs 4.6 trillion from mutual funds, Rs 3.2 trillion from insurance companies, and Rs 2.2 trillion from pension funds, fueled by Rs 11.6 trillion inflows from mutual funds, insurers, pension funds, and others in total. Currently, 32 listed trusts hold Rs 10 trillion AUM with a 5 trillion market capitalization, and annual primary market opportunities exceed Rs 1 trillion, with 2 to 3 IPOs expected yearly from 2024, supported by new asset classes like data centers.
That's a huge untapped potential since domestic institutional investors are using only 7.5% of their investment limits, leaving around 7 trillion rupees available, which should boost the economy, market depth, and liquidity significantly. Expansion into data centers and increased retail participation will drive growth, though new REITs face limits due to scarce mature office and retail assets. Still, given the favorable regulations and growing retail participation, these trusts are becoming key long-term investment vehicles, offering stability amid global interest rate challenges and helping recycle capital for new infrastructure and real estate projects.
India's silver imports plunged 87% in May to Rs 75 crores, the lowest in over 3 years, following strict government import restrictions and increased duties from 6 to 15%. Importers now face mandatory prior authorization, with silver grain and powder added to restricted goods, impacting over 80% of India's silver demand sourced from the United Arab Emirates, Britain, and China. These measures aim to reduce the trade deficit and support the Indian rupee amid high global oil prices, but they raise local silver premiums and could tighten supply for sectors like jewelry and solar energy.
This policy shift may lower global silver demand and prices since India is the world's largest consumer, while domestic investment in silver exchange-traded funds has surged, showing shifting market dynamics. Despite strong demand, especially from investment in silver exchange traded funds, importers face strict controls as over 80% of silver is imported mainly from the United Arab Emirates, Britain, and China. And these constraints on the world's largest silver consumer could tighten global supply and potentially increase silver prices internationally.
Bharti Airtel has set up Airtel Global IFSC Limited as a wholly owned finance subsidiary in Gujarat International Finance Tech City or GIFT City on June 15, 2026. The company has an authorized and paid up share capital of 20 million Indian rupees, that's rupees 2 crores. The subsidiary's entire shareholding is held by Bharti Airtel, ensuring full control, and operations will include treasury activities and other services permitted by the International Financial Services Centers Authority.
This move leverages GIFT City's regulatory benefits, positioning Airtel to centralize and optimize its global treasury operations. It reflects a strategic shift to an international financial services hub, enhancing their financial management and operational efficiency. This aligns with market trends where companies optimize liquidity and risk management through dedicated global treasury centers in such hubs, potentially improving financial efficiency and cost management.
The Reserve Bank of India's proposed framework could unlock refinancing worth rupees 26,000 crores for office real estate investment trusts starting fiscal year 2027. It also enables new funding of rupees 75 to 80,000 crores at a 40% loan-to-value ratio. The office REIT sector is now a rupees 2,40,000 crore asset class, with assets covering 16% of Grade A office stock in 7 major cities, and despite rapid growth, listed office REITs have maintained a gross loan-to-value of about 24%, well below the proposed 49% ceiling, allowing ample room for borrowing if the RBI framework is approved.
That's significant given the regulatory change can boost acquisitions and portfolio growth. Strong occupancy rates above 80%, especially over 90% in Bengaluru and Mumbai metropolitan region, ensure stable rental income. This supports investor confidence and positions REITs to expand as borrowing diversifies beyond capital markets. High occupancy rates in major markets ensure steady rental income, making REITs attractive for investors and enabling portfolio expansion with this fresh funding.
India Ratings reaffirmed Birla Corporation's credit rating at IND AA with a stable outlook, reflecting strong fiscal year 2026 financials. Revenue rose to rupees 9,660 crores, up 4.9%, while EBITDA jumped 19.1% to rupees 1,450 crores. The company improved gross interest coverage to 5.5 times from 3.7 and reduced net leverage to 1.4 times, with capacity utilization at 95% versus the industry average of 65 to 70%.
This rating stability supports investor confidence amid their ambitious 6.2 million ton capacity expansion planned through fiscal years 2027 to 2030, funded with a 2-to-1 debt-equity ratio, and maintaining leverage below 2.75 times is critical to sustain financial health. However, risks persist, including volatile input costs for petcoke and coal, potential working capital pressure in fiscal year 2027, and an ongoing ownership dispute. Investors will watch leverage management and EBITDA per ton targets closely as these factors evolve, alongside Birla's goal to exceed EBITDA of 1,000 rupees per ton within 2 to 3 years.
The Reserve Bank of India is banning compulsory bundling of third-party products with bank services starting January 1, 2027. Customers can't be forced to buy, say, life insurance from a bank's partner when taking a home loan. They must have freedom to choose any provider for risk mitigation. RBI also forbids manipulative digital tactics like fake urgency timers and pre-selected add-ons, and banks must audit their platforms regularly and disclose all direct selling and marketing agents publicly, ensuring these agents do not impersonate bank staff.
This change empowers customers to choose third-party products freely and heightens transparency, requiring banks to get clear documented consent through signed declarations or digital confirmations before any sale, which should reduce mis-selling risks significantly. These rules boost customer protection by ensuring agents are clearly identified and key product details like fees and risks are explained upfront, strengthening trust in digital financial sales and helping customers make informed decisions.
Neogin Fintech posted a net profit of rupees 5.1 crores in fiscal year 2026, reversing losses of rupees 9.8 crores last year and losses from the previous 2 years overall. Total income rose sharply to rupees 118 crores, with assets under management growing to rupees 336 crores. CRISIL reaffirmed their long-term rating at BBB- and upgraded the outlook from negative to stable, signaling stronger financial confidence, and their new non-convertible debenture issue of rupees 50 crores also received a BBB- stable rating.
This turnaround shows improved operational efficiency with expenses dropping to 14.9% of assets. However, gross non-performing assets remain a concern at 7.9%, only a slight improvement from 8.4%. This could impact credit costs and earning stability given their modest scale. Market watchers will focus on how well Neogen sustains profitability while reducing asset risks, managing GNPA reduction, and expanding in the competitive fintech lending sector.
The State Bank of India's board will meet on June 18, 2026 to approve raising capital through debt instruments for fiscal year 26 to 27. They may issue these via public offer or private placement, targeting both domestic and international investors in Indian rupees or foreign currency. SBI's shares recently rose by 0.35%, reflecting positive market sentiment ahead of the meeting, and given SBI's dominant role, the board's decision will influence broader debt markets and set a tone for other financial institutions' capital raising in the upcoming year.
This shows SBI's strategy to strengthen its balance sheet and increase lending capacity, and the flexibility in currency and investor base could optimize their capital costs. Market watchers are attentive since SBI's decisions significantly impact India's banking sector and debt markets, and the outcomes on June 18th will likely influence bond yields and banking sector confidence going forward.
The Reserve Bank of India, effective June 13, 2026, allows non-resident Indians and overseas citizens of India to maintain designated repatriable rupee accounts for investments, simplifying cross-border financial management. Additionally, all equity transactions by foreign individual investors, including NRIs and OCIs, on Indian stock exchanges must be reported by designated authorized dealer Category 1 banks to the RBI using Form LEC-IFI. Improving transparency and regulatory oversight and greater transparency will likely strengthen compliance and market integrity, reassuring both domestic and foreign investors about the governance of cross-border equity flows.
This change means NRIs and OCs can now use these specific accounts exclusively for permitted investments, improving ease of transactions and potentially increasing foreign investment inflows. This move will enhance liquidity and flexibility for NRIs and OCs, making it easier to handle investment proceeds and payments through regulated channels, boosting confidence in investing back into India.
Bandhan Bank approved the sale of non-performing assets amounting to Rs 304 crores from its housing finance portfolio via the Swiss challenge method, targeting loans overdue by more than 180 days as of May 31, 2026. In Q4 fiscal year 2026, Bandhan Bank's net profit surged 68% to Rs 534 crores, driven by a slight 1.4% rise in net interest income to Rs 2,795 crores, and the rise in retail deposits to over 73% of total deposits also reflects growing customer confidence and stable funding.
This move helps the bank clean its balance sheet efficiently, and the Swiss challenge ensures competitive bidding, potentially maximizing recovery while improving asset quality, crucial in the current credit environment. Profit growth alongside gross NPA reduction to 3.27% shows better asset quality and operational strength, enhancing investor confidence amidst tightening credit conditions. Mahindra & Mahindra Financial Services also approved a secured non-convertible debenture issuance up to 1,000 crores rupees at a fixed coupon rate of 7.90% per annum, maturing in 3 years in June 2029, with listing on BSE's wholesale debt market. The debentures have annual interest payments of 7,900 rupees per 1 lakh face value, with principal repaid at maturity, and delays exceeding 3 months incur an additional 2% per annum interest over the coupon rate, while the private placement structure and green shoe option up to 500 crore rupees enhance flexibility depending on market demand.
The Reserve Bank of India will let non-banking financial companies distribute insurance products without prior RBI approval starting January 1, 2027, as long as they have authorization from the Insurance Regulatory and Development Authority of India, and banks can continue as insurance brokers but only through agency business on a fee basis without risk participation, clearly disclosing their limited role. Foreign institutional investors bought $1.84 billion in Indian bonds during the first 5 trading days of June 2026, the highest monthly inflow since March 2025 following the government's removal of capital gains and withholding taxes on bond investments, which could attract $45 to $50 billion over 2 years. The 10-year government bond yield dropped 13 basis points to 6.87%. The rupee gained nearly 1% in June, and finally Zerodha, Grow, Angel One, and Upstocks received approval from the International Financial Services Centers Authority to offer international and US stock investing through Gift City, tapping into global interest sparked by the SpaceX IPO valued at $1.75 trillion and the AI-driven market surge, with the rollout expected in 2 to 3 months. That's a wrap for today's The Debt Circle podcast. Thanks for listening.